Hello, everybody. This is Chuck Carnevale, co-founder of FastGraphs, the Fundamentals Analyzer software tool, also known as Mr. Valuation. In my last video, I covered 5 tech stocks in the data processing and outsourcing subsector of information technology. And as I kind of reviewed those companies and others, I've learned that there are several companies in that particular sub-industry sector, especially that are related with payment services and things like that have had some weakness in their stock prices lately. And as an offshoot of that video, I was asked by subscribers to look at Western Union and Fiserv. And as I got looking at Western Union and Fiserv, I found some interesting synergies that I'm going to kind of cover in this video. But the bottom line is, I also thought these two particular companies would be very interesting to cover because I often talk about, you need to invest according to your investment objectives. Investing is not a one-size-fits-all. There is no such thing as the best investment. There's only the best investments for you, and that's based on your risk tolerances or your tolerance for risk, your goals, your objectives, how much you understand investing, how confident you are, how patient you can be. There are a lot of factors that come into investments, in investment decisions that are beyond just how much money can I make, because the more money you potentially can make in theory, the more risk you must be willing to take to do that. So there are a lot of differences there. The particular companies I'm covering here, interestingly enough, both of them offer a very similar rate of return potential over the next couple of years at least, not necessarily real long term, but over at least the next 2 to 3 years. But what's interesting is each of these companies would accomplish those total returns in 2 different ways. With Western Union, you've got a high yield dividend payer, and with Fiserv, you've got a pure growth stock with no dividends. So let's go ahead and turn to FastGraphs and start looking at these two companies. And there are several what I would call teaching moments that I would want to interject in this particular video that I think is important as I cover these two companies. So the first one I want to look at is Western Union. And what I want you to note about Western Union is the stock is extremely undervalued, okay? It historically trades at around a 12.5 PE. That would be the fair market value. I believe its intrinsic value ought to be 15, and you can see that there are times, that's the orange line on this graph, there are plenty of times where the stock has traded at a 15 PE. You can see it, right here. You can see it coming out of the Great Recession. But for the majority of the time here, the stock has traded at around a 12.5 PE, which is the blue line here, 12.48 times earnings. So the market likes to discount this particular stock. But I also want you to note that coming into the Great Recession, the stock was way overvalued, okay? And now it's way undervalued. And that becomes very, very important when you're looking at reviewing performance, because this is one message that I want to give, and I give it a lot, and that is measuring performance without simultaneously measuring valuation is a job half done. And to translate that into maybe something that more palatable for many of you, the point is, it's not just so much to know what the performance has been, but you need to know how the performance was created, what factors came into play that generated that performance. So when you're analyzing Western Union, as far back as when the company was spun off here, which is 2006, 2007, you could see it was overvalued and now it's undervalued. So the first thing I want you to basically focus on is that you're measuring performance from a very high valuation to a very low valuation, okay? So from the standpoint of expectations, I can just look at this graph and know that I'm going to have very, very poor long-term performance from a capital appreciation perspective, at least. The other thing I want you to note is the company's earnings growth rate has only been about 4.34% over this time frame. Now, this goes back to the, we're adding features all the time, but the 17 metrics and features that I like to look at when I'm analyzing a stock, and earnings growth, of course, is one of those first ones. Dividend growth and the dividend growth trend is another one. Now, there's some very interesting things about the company's dividend. You can see by, we express dividends 2 ways on FastGraphs. We stack them on top of the orange line to illustrate that they're paid out of earnings. But the white line plots the dividends per share, and the area below the white line gives you the dividend payout ratio. So you can look at this graph and instantly know that when it first was spun off, it had a very, very low payout ratio, actually only paying out 2 or 3%, up to 5% of the earnings to shareholders in dividends. And you see a very light, a very slight light green shaded area atop the orange line. But then you can see the payout ratio increased pretty dramatically in 2010 to 17%. Then it went up to 19, almost 20%. Then it went up to 35%, and then up to 37%. And more recently, they've been paying out about half their earnings, 48% in terms of dividends. So it's becoming much more of an income stock, which is what it is anyway because of its low growth rate. But again, the moral is when I measure performance by looking at this graph, before I even see a number, I know that I'm going to have very poor capital appreciation, but I'm also going to have a decent amount of dividend income despite the fact that I overpaid for the stock. So let's measure the performance. When I look at it from a standpoint of going back to December of 06, I ended up with a negative rate of return. I turned $10,000 into only $8,100, but that was because I bought it when it was overvalued. I want to emphasize that. I'm measuring it now when it's undervalued, and the company has a very weak, or I'm going to say average rate of earnings growth of under 5%. Now, I add dividends. Even though I overpaid for it, I was comparable to the S&P 500 in terms of dividend income, and I got extremely good dividend income growth. Now, the dividend income growth, even in recent years, has probably been averaging, high single digits to even low double digits, but there were times when the dividend growth was very, very explosive, and that, of course, had to do with the fact that the company's payout ratio was also exploding, as I illustrated earlier in this, in this video. So now what I want to do is I want to calibrate this. So I'm going to start cutting some time off here, and I'm going to get it down to just coming out of the Great Recession when the stock was essentially fairly valued based on what I would call its intrinsic value, which is the orange line, and moderately overvalued based on the normal valuation multiple, the blue line, the PE ratio line. Okay, and here now I'm going to get a little better performance, but it's still not going to be great. I've got less than a 1% negative loss. I've got pretty good, decent dividend income, but again, I've got a very weak and poor investment here. Now I'm going to calibrate this a little more for you. I'm going to take a couple more years off the graph. Now I'm going to buy the stock at its normal market value, a PE of around 11 here. And I'm, currently trades at a PE of 9, so I'm still going to get some PE contraction. I've got less than 4% earnings growth here, but I do have a 5.15% dividend yield. So in this case, I'm breaking even on the stock. I've not made any money, not really lost any money, and I've actually got more income than the S&P, but only slightly more. But again, the point is I'm measuring it from being reasonably valued to being undervalued. So measuring performance without simultaneously measuring valuation is a job half done. Now, the third thing I like to look at when I'm doing my fast fundamental analysis, besides earnings growth and dividend growth and the trend of dividend growth, if any, is I now want to look at reasonable return expectations. So I go to the forecasting calculator, and I've got some interesting aspects now. Forecast growth is expected to be about 9.5%. There's reasons for that, which you can do when you do your research. The company is really leaning on digital. They're going to be unwinding a couple of their business unit, which is a very low margin, low profile business. And so they're going to focus more on their core competencies. But the point is, that's giving analysts confidence that the growth is going to be faster than historical norms. And if that's true and the stock trades at a 15 PE, you would have the opportunity to make over 40% annualized. In the next year plus, you'd be, making even more than that. You could increase, your total return would be 75%, but that includes dividends at a rate of 5.15%. currently. So this is a very high yield investment. If I go to the normal multiple graph, okay, and I use the most conservative last 5 years, the market has put an average multiple in this stock of about 11. Okay, so at 11, I still would have a very high rate of return expectation of over 26% a year out to 2023. If I use the more long-term normal multiple, which has been about 12.5, and I add that to the graph, I now would have a rate of return expectation of 31. Now, I want to focus you on that. That would be the total return, which is a function of earnings growth at 9.5%, PE ratio expanding from 8.9 to 12.48, which I still consider low, okay, plus dividend income, all right? So that's what that total return would be built of, and that'll become important when I look at my next example here a little bit later in the video. All right, so going through this, I've gone through all the things now that I think are, or the first three or four things are important. It does have my investment grade rating. It's a BBB credit rating, which I like. And by the way, I've got these metrics listed underneath the video here. The next thing I'm going to look at now is valuation. I really want to focus on valuation. I see the stock being extremely undervalued currently. That's very important based on operating earnings. If I measure it based on free cash flow, which I've used this metric to cover two things before I leave fast graphs. I want to see the free cash flow, which is the orange line. Forget about price for a moment. I want to see free cash flow covering the dividend, and I've got great free cash flow coverage, significantly greater than the dividend, in other words. And then I also want to do the same thing with operating cash flow. I want to see operating cash flow covering the dividend, but the real acid test is the free cash flow. But I also want to see operating cash flow growth for the last 3 to 5 years. And again, I also would like to see free cash flow growing for the last 3 to 5 years. Now, the numbers aren't, the growth rates aren't high here, but they've got good, solid free cash flow growth. So now I've run this thing kind of through the metrics, if you will. And with every one of these metrics, if I do bring price into the equation, Western Union looks very, very inexpensive. It looks very inexpensive based on even its normal market free cash flow valuation. It would look inexpensive based on its normal operating free cash flow. I could go through some of these other metrics, which I always do before I leave fast. I'll look at EBITDA. It looks very inexpensive based on the normal or market EBITDA value. I can also look at EBIT, which is operating margin. It looks very inexpensive based on EBIT. And then last but certainly not least, I'd look at it from a standpoint of price to sales. And the company looks very undervalued relative to how the market, normally, values this somewhere around 2 times sales. Or you could also argue less if I just ran my mouse here. 1.5 to 2 times sales would be good. It currently trades at 1.48 times sales. So in every aspect, this company looks very, very inexpensive. So what I'm going to do now is I'm going to turn to the financials, okay, and go through the rest of the metrics that I like to talk about. And I've added a new one here. And the one that I've added, because I think it's really important, is share buybacks, okay? So I'm going to go to basic or diluted shares outstanding. I'm going to do both of them, and they're virtually identical. And what you see here is that the company has been buying back their shares. Now, keep in mind, this has been a low PE stock over all these years, so I kind of like that. So I've added a metric that says share buybacks valuation based. I like share buybacks if the company's stock price is inexpensive. And if I go back to fast graphs, by almost any measure, the company's stock price has been very undervalued since coming out of the Great Recession. And so as I look at fund graphs and I go into the share buybacks that I just showed you, you can see the company's been buying back shares as it's come out of the recession, and it's been doing it when the share price is inexpensive. I think that's good shareholder value creation. The other way you create value, of course, is with dividends. And that's why I added share buybacks, because I've already kind of covered dividends. So I like that. The company's buying back shares. They've reduced their share count from 768 plus million to 415 million by the end of last year. The next thing I want to look at is I'm going to go into the income statement, all right, and I'm going to look at net income, okay, and then I want to go to the cash flow statement and look at net operating cash flow or operating cash flow, and I want to see operating cash flow higher than net income. Now, I've got a little bit of an issue here. The margin is not getting very high. In fact, there are times here when net income is actually lower than operating cash flow. And, my objective here is to see cash flow from operations higher than net income. Okay, so cash flow from operations is the gold, and the net income is the red bar on this graph. And there are times when that's reversed. And there was, this was tax reparation, which was affected a lot of companies. So I'm going to kind of overlook that. But generally speaking, I don't consider this real strong. They barely have cash flow from operations higher than net income. So that's a little bit of a concern to me. But I'm going through a lot of different metrics here. Now, I also want to see sales growth trend. I want to see what sales look like. So I'm going to go ahead and check sales growth here and look at sales growth. And the revenue growth has actually been dropping. Now, I know from, doing research, it's beginning to increase again. So that's starting to change, but it doesn't have great sales growth over the last 3 to 5 years, but it's still maintaining its sales. So again, that would be another area I would say the company's a little bit weak on. So the next thing I would look at, I want to see net income growth. So I would go look at net income growth. And here again, it's starting to improve, but it's been a little bit shaky over the last, 3 to 5 years or so. So that's something that I'm, moderately concerned about. Now, next I want to talk about debt to equity ratios. Okay, so let's go into the ratios here and let's look at the liquidity ratios and let's look at debt to equity. And let me get rid of these valuation ratios that I have on here. And looking at debt to equity ratio, the key is it's 0.14. Now, I like to see 1 to 1. In other words, I want to see that number is 50. So let me show you this another way that I think clarifies it even better. I'll go back into the company's balance sheet, if you will. All right, and what I'll do is I'll get total equity, click on total equity, and then I'll go to total debt and go to total debt. And what you see here now is that the company has significantly more debt than equity. They've actually destroyed equity over the last several years. That's something I really want to understand better before I would actually lay any money down on Western Union. Now, another simple one, I'd go back into the ratios graph, and I like to look at net and gross margin. So I'm going to go into profitability ratios. I'm going to get rid of the liquidity ratio here. I'm going to look at gross and net margin. In 2017, again, that was the tax issue. I'm guessing they had negative net margins, but their gross and net margins, are pretty decent. The company's growth margins are in the 35, 36% range. Net margins in the 15 to 20 range. That's decent, especially for this company. Now, I'm also going to I'm going to go back into the millions graph here, and I'm going to look at assets to sales here, because I think, I'm going to try to see what the company's asset turnover has been. So I'm going to go into the company's income statement. I'm going to check sales here, and then I'm going to go down to the balance sheet, and I'm going to look at total assets. And what I see here is a kind of a modest ratio. They're not, based on the amount of assets they have, they're not generating a lot of sales with those assets. So I don't consider that great, but I don't consider it real bad either. Now I'm going to go back into the ratios graph here, and I'm going to look at some profitability ratios, if you will, some additional ones. So I'm going to go get rid of gross and net margin here. I'm going to look at returns on assets. And again, the returns on assets have been, weak. They're getting better. So that's marginal with this company. It's about 8% for last year, almost 12% the year before. So I like to see that number being 10% or better. So that's, again, not one that I'm real excited about. Returns on equity. I like to see returns on equity of 15% or better. It's getting back up there to where it has a very, very high return. Well, it's not back up there. It's got an extraordinary return on equity right now. But again, that's because the company virtually has no equity. They've literally destroyed their equity. So that's, something that I'd be concerned about. And then last but not least, I want to look at operating margin. I'm going to go back into the millions graph, and I'm going to look at EBIT, which is earnings before interest and taxes, which is, you could call that operating income, if you will. And then I'm going to look at that based on sales or divided by sales. I'm going to get rid of the total assets column here. And, you can see that the company has total sales of over $4.8 billion last year, and their operating income was about $1 billion. So, it's decent. It's not great. It's not bad. It's decent. So anyway, that gives me a quick overview of Western Union. There are some things I want to basically, by going through that process, I want to look at further, but I really like the valuation. I do like the fact that earnings growth has been accelerating. I do want you to notice that. See, it's been historically about a 4% grower. But if I shorten this graph to the shorter time frames, you can see that the growth rate has, increased. You can see it's had 7%. It did have a negative year, but then it was 8, 11, 9, and 9, and that's including the forecast. So, it makes sense that this 9% forecast is great, and I got this great total return potential. So that's Western Union. Now, the other stock I said I was going to cover, and I'm going to only just highlight this one. I'm not going to go through all the metrics, but I would recommend you do that. I'm going to take a look at Fiserv. Now, Fiserv is a very interesting company. The difference here is, I want you to notice there's no white line, there's no dividend. The company's earnings growth has been about 16% a year. If I shorten that time frame, it stays around that 16% time frame. Forecasting, the company is expected to grow at 19.5, almost 20% a year. And if I go look at my rate of return based on what I would call a 19 fair value PE, that's about a 19% rate of return. If I use the normal multiple, and I want you to notice with this stock, the market tends to put a premium multiple on this stock. So if I went to the forecasting graph and looked at the normal multiple historically over the last 5 years, it's been about 25, I would have that 30+% rate of return on Fiserv. Now, the whole moral of this story is Fiserv has been a very, very expensive stock. Sometimes this goes on for long periods of time. Sometimes it ends quickly. But I want you to notice the price is beginning to drop. The company is coming close into fair value. I would want to see this stock cheaper before I personally wanted to invest in it, because when you're dealing with pure growth only and no dividend, your risk is a lot higher, but you're compensated by that because the performance of this stock has been exemplary historically, especially when you buy it at an attractive valuation. If you could have bought it coming out of the Great Recession at 11 times earnings, and the company grew at just about 16% a year, and you'd have made 20% on your money. That's where valuation works, and the opposite of what I showed you with Western Union. So these are two very interesting stocks in the data processing and outsourced service sector. I think both of them have a place. If you're looking for pure growth and you're young and you're willing to take the risk, perhaps, this is a growth stock. If you can get this stock a little cheaper, I would say this is one that should go on your radar screen right now. If you're looking for current income, buying Western Union today, I think makes a lot of sense because it's so inexpensive. This really helps reduce risk dramatically. You've got some accelerating growth going on. Again, your research can help you determine whether you believe that or not. And, there's, even if you're conservative or aggressive, you've got some really nice rates of return that can be made with a dividend income to help mitigate that risk. Anyway, this has been a look at one growth stock and one income paying stock. Has been Chuck Carnevale saying thanks for watching. I hope you enjoyed this video. As always, if you liked the video, give me a like, subscribe to the channel, ring the bell, give me the thumbs up. And also take a look at FastGraphs. What a marvelous tool to help you ascertain the health of a company, its current valuation, and whether you should be buying, selling, or holding it in the long run. Thanks for watching.